Question number 36. An American firm is under the obligation to pay interest of Canadian dollar 10,10,000 and 7,05,000 on 31st of July and 30th of September respectively after 1 month and 3 months. Okay. The firm is risk averse and its policy is to hedge all the financial foreign currency transactions. The finance manager of the company is of the opinion that hedging through two techniques, which is the forward and the options. Okay, the forward and the options. The forward or the options, rather, you have to select. You have to give an answer where the outflow will be less because it's payable. So the outflow which is lesser will be selected. Either the options cover or the forward cover. Correct? Now, right now it is June 30th, the spot date. Following quotations are available. Spot is available, bid and ask. 1 month forward, 3 month forward is available. Okay, so using these rates, you can very easily find the forward contract cover rates, which is the outflow in case you are hedging through a forward contract. Right now only we'll do it, or what? Let's do that before we move on with the question. It's very simple. See, Canadian dollar is my exposure. My rates are also Canadian dollar per Canadian dollar, US dollar per Canadian dollar. Basically, dollar by Canadian dollar is my quote given to me. Even if you see it logically as well, 1 Canadian dollar is equal to, let's say, we take this rate, 0.9356. Yes, because Canadian dollar is a weaker currency when compared to the American dollars, right? So, when I solve this, or should we, okay, let's do it anyway, but I don't have the space. Here we can do, see, forward hedging, outflow. Let me reduce this. Okay, 30th, 31st of July and 30th of September. Correct. So here the outflow is $10,10,000 and it's a, not dollar, Canadian dollar. It's a Canadian dollar exposure. The quote is also Canadian dollar. 1 month forward, what is the quote? 0.9301. So into dollar by Canadian dollar, 0.9301, which comes up to how much? 9,39,401. What? Dollars. Similarly, here also you do. Let me just change this color. Canadian dollar 7,05,000. Multiply this by dollar by Canadian dollar quote, which is the 3 month forward quote given to me. Only one is given. Bid and ask is also not there. 0.9356. 0.9356, which gives me dollars something. Canadian dollar goes. That something is 7,05,000 into 0.9356 gives me 6,59,598 what? Dollars. Correct? So in forward hedging, if I have the outflows with me after 1 month and after 3 months. Correct? 2 different outflows. Got it. This is fixed. Now the second thing that they are asking is, so see, one thing I've done, forward is done. Second is options contract. Here we have to pay attention. Okay, this is the first part. For options, let's read further on. Price for Canadian dollar by US dollar, this is not correct. See, because they've said further, if you see, cents per Canadian dollar. Cent is nothing but equivalent of paisa in rupee. So US dollars and US cents. So basically this is dollars and this is Canadian dollar per Canadian dollar. Clearly they've said. So this is nothing, this quote we've already seen above as well. These quotes are dollar by Canadian dollar quotes. Okay, let me change this right now. Payable on purchase of the option. The contract size is given to me, Canadian dollar 50,000. Strike price, calls and puts. This information is given to me because I have to hedge using the options contract. Strike price, I understand, the exercise price. Okay, the entire thing is dollar by Canadian dollar. Once again I'm writing. Calls and puts, what are these July, September rates? These are nothing but call and put premium for these respective maturity dates. Okay, these are premiums. Got it? Now moving on. How have they told me how will you hedge using options? I know, but how will you hedge and what strike price? See, 3 different strike prices given to me. Which one to use? So for that, let's see the question only. They'll guide us. According to the suggestion of the finance manager, if the options are to be used, now if you use the second option, which is to hedge through options, then 1 month option should be bought at a strike price of 94 cents. Okay, this for 1 month. Which call or put, that we have to decide and we have to analyze. They have just said use the strike price of 0.94 in case you are hedging for 1 month exposure, which is 10,000 Canadian dollars, and 3 month option at a strike price of 95. Okay, so for 95 you use the September for 3 month, that is September 30th September. For that you use 0.95 strike price. So now this is fixed. Great. Call and put we have to analyze. Okay, one more thing they've said is, and for the remainder uncovered option, the firm would bear the risk itself. For the remainder uncovered option, the firm would use the forward rate as the best estimate of the spot. Okay, the forward rates are given to me. Great. Ignore the transaction costs. Recommend which of the following 2 methods would be appropriate for the American firm to hedge. Which method will you recommend? Simply the method where the hedging technique where the outflows are limited. The outflows are lesser compared to the other option. Very simple, right? First of all, before even starting the solution, this is question number 36, was it? Let's first analyze, in case of options hedging, what will you use here? Which option? Either call or put, that is certain. So call or put what? See, very simple. What is my exposure? Quickly we'll understand this. In both the cases, be it 31st of July or 30th of September, my exposure is Canadian dollars, right? The currency is Canadian dollars. Okay. Now, what is my quote that is available to me? The strike price. In case of options, you have the strike price, right? The strike price that is given to me also is a Canadian dollar per Canadian dollar. Remember, dollar by Canadian dollar. So this is also a Canadian dollar quote, and my exposure is also Canadian dollar. Got it? Now, what is my transaction? My transaction, as in, is it payable or receivable? Payable interest of 10,10,000 and 7,05,000, if you remember the question. Canadian dollar, both these are Canadian dollars. Okay, so payable, basically my transaction is payable and my exposure is Canadian dollar. Okay, payable means what? Payable means I have to buy Canadian dollar, correct or not? Payable Canadian dollar is equal to buy Canadian dollar. Fortunately for me, the quote that is available to me is also a Canadian dollar quote. It's a dollar by Canadian dollar. Everything is matching clearly, right? So buy Canadian dollar. Now, in case of options, there is call and then there is the put option, correct? Call means what? Call is buy. Okay, buy Canadian dollar in this case, and put is sell option, correct? Now in my case I have to buy Canadian dollar, so call option fits very perfectly because the strike price, the quote that is given to me, is also a Canadian dollar quote, basically dollar by Canadian dollar. Are you able to understand this justification? Correct? Why call option is selected? Because I have to buy Canadian dollar. Buy is call option, correct, which is given to me. Okay, so now your outflow will be in terms of Canadian dollar or dollar. If you notice, the outflow in case of forward contracts that we did was also in terms of dollars, right? And strike price is given to me, so Canadian dollar will cancel out and I'll be left with a dollar outflow. But remember, in case of options, you also have to pay something called as premium, which has to be paid on spot, upfront premium. So that is also going to be added outflow for you. Let's start the solution finally. Second option strategy, which is options hedging. Correct. Now in case of options hedging also, they had given the question very clearly that in case of any extra contracts, you have to hedge that through the forward rate. Okay, so let's first find out the number of contracts for that, because the contract size was given as Canadian dollar 50,000, if you remember in the question. This was the contract size. So using this, let's first find out the number of contracts. So we would know that how much will we hedge using the call options and how much with the forward rate. So first is 31st of July, and the second is 30th of September. Okay, 31st of July the exposure was 10,10,000 Canadian dollar. Do not forget the currency. And my size of contract is also Canadian dollar 50,000. Good. In this case it was Canadian dollar 7,05,000. Size is also Canadian dollar 50,000. This is same size of contract in both the cases. So what I am left with is, this will come up to 20.2 contracts, and this will come up to 705 divided by 50,000 is 14.1 contracts. Okay, now basically I have 20 and 14 full contracts, right? The balance, that is 0.2 and 0.1, are the excess which has to be covered or hedged using forward rates. Correct? So for this, let us hedge through the call options. Okay, so let me prepare a table. So this table I have prepared. 31st of July was one transaction, 30th of September another. My different currencies involved is Canadian dollar and dollar equivalent, which I'll make it using the strike price. Okay, that is given to me, and Canadian dollar and dollar for each July and September. Now we just discussed covered by call option. How much is covered by call and how much by the forward rate? So by call option, in case of Canadian dollar, 20 contracts into what was the size, 50,000 Canadian dollar. This much is covered, that is 10 lakh Canadian dollar is covered. So balance 10 lakh 10,000 minus 10 lakh Canadian dollar gives me 10,000 will be covered using the forward rate. Got it? How I'm getting these numbers? Great. Now these 10 lakh is hedged using call option. So by the strike price. Now what is the strike price for 1 month? Standing today, that is 30th of June. In the question it was given. Today is 30th of June. So 31st of July is after 1 month. So we see 1 month. Let's go to the question once again. See, 1 month option should be bought at a strike price of 94 cents. So we've selected put is of no use to us, call is what matters. We've selected this after coming, after a lengthy discussion. Now, so strike price is 0.94. Once again we'll see 94 for 1 month, 94 for this July, 1 month. This is the strike price and this is the premium amount, 1.02 is the rate. Okay, let's go back to the solution. Now in order to get dollar equivalent of this 10 lakh, what should I do? Divide or multiply using the strike rate 0.94. We've selected 0.94. Now this is, once again I'm writing Canadian dollar 0.94. Let me write somewhere else. 0.94, this is a strike price. Okay, 1 month call option. Got it. 0.94 is what? Dollar by Canadian dollar. We have seen this repeatedly. Okay, so basically a Canadian dollar quote, and this is also Canadian dollar exposure, so we have to multiply this. When you do that, 0.94 into 10 lakh, simple, 9 lakh 40,000. What? Dollars. Dollar. Okay, I don't have to write this dollar here because it's clearly mentioned in the heading itself, but still, got it. Similarly, we do it for 30th of September also. First, let's do whatever is covered by the call option. So here it is 14 contracts into the size of one contract was 50,000 Canadian dollar, which is fixed for both July and September. 14 into 50,000 is Canadian dollar 7 lakh. So balance, my total exposure was on 30th of September 7,05,000 minus 7 lakh is already covered by call option. So balance will be covered by the forward contract. This balance is coming to Canadian dollar 5,000. Correct? Now, the strike price for this one after 3 months was 0.95. Okay, let me write down. Strike price, again call option, but in this case it's a 3-month call option, right? The strike price was dollar by Canadian dollar 0.95. Okay, a Canadian dollar quote and the exposure also Canadian dollar, so I have to multiply. So 7 lakh into 0.95 is 6,65,000 dollars. What I need. Okay, but see, if it was a forward contract, this would have been the end. This is the total outflow, $9,40,000 and $6,65,000 respectively. But that's not the case. In case of options, in case of the options hedging strategy, you also have to pay something upfront, which is called as premium. So I also have to add that. But before that, we are forgetting one thing, is the balance portion, which is 10,000 and 5,000 here, has to be covered using the forward rate. So let's see the forward rate. This is the forward rate, 1 month and 3 month, right? So 0.9301 and 0.9356. Okay, so we multiply this. Canadian dollar 10,000 into dollar by Canadian dollar 0.9301, and this is Canadian dollar 5,000 into dollar by Canadian dollar 0.9356, was it? 9356. Maybe it's not properly visible, but it's the forward rate, 3-month forward rate from the question itself. Okay, so let me do a line here and we get these answers here. Okay, let's do this. This was simply done. Dollars, currency is important. Here I will not be able to fit in, so let me dollar here. 5,000 into 0.9356 gives me $4,678. Okay, so now it's complete. Now I have everything in dollar except one more thing, premium. Let's see the premium. Premium is basically here dollar by Canadian dollar only. It's given in the question. See the question here. Let me use a different highlighter if that's okay. Let's just delete these things. Okay, so 0.94 was for 1 month call option, so my premium is this, and for 0.95 3-month call option, my premium is this. Correct? I hope you understood how I got the premium. Super easy. Call option for 1 month for 0.94, this 1.02. Call option for 3 month for 0.95, 1.64. Correct? So here the premium would be 1.02% into how many contracts? 20 contracts, right? The call option hedge was only for the 20 contracts part, but the balance 10,000, it was using the forward rate. So 20 contract into 1 contract is equal to Canadian dollar 50,000 contract size. Okay, similarly here also we do. Here it was 1.64% into 14 contracts using call option strategy into 1 contract size is Canadian dollar 50,000. Now all we have to do is just calculate these numbers. So 20 into 50,000 into 1.02% is 10,200 watt dollars. Okay, why dollars? I hope you understood. Next is 1.64, 14 into 50,000. Wait, 14 contract into 50,000 into 1.64 percentage is 11,480 dollars. You have to add all these things, the dollar equivalents. So let's add one by one. In case of 31st of July, first let's do that. 9,40,000 plus another one was this one, 9,301 plus this one, 10,200 premium, 10,200. This comes up to 9,59,501 what? Dollar. Okay, similarly here also you'll add for 30th of September. The first one is the 6,65,000 and 4,678, the balance which is hedged through a forward contract. So plus 4,678 plus the premium as well, plus 11,480. This comes up to 6,81,158 what? Dollars. Correct? Dollars. So now we have to compare. This is the, let me write this, therefore total outflow using, if hedged through options strategy, okay, provided by the finance manager, that part will be using the options and part will be using the forward. So this is the total outflow basically. If you compare these outflow with the forward cover that we had done initially, remember, whichever is lesser will be your advisable hedging strategy. Common sense, because you have to pay. Your exposure is Canadian dollar and your transaction is payment outflow, right? So let's compare. See the solution. Here only we'll compare. We've done this entire thing. Let's go to the solution quickly. Forward market cover we did for July and September. This entire thing we had this outflows. Okay. For options contract, first we did was find out the number of contracts, 20.2 and 14.1. Out of this only I can have a call option for 20 and 14 respectively. So that's what I did for 10 lakh and 7 lakh, right? So in that equivalent dollar terms, US dollar terms would be 9,40,000 and 6,65,000. How? Using the strike price. Very simple, 0.94 and 0.95. I'll write down if you want. This is 0.94 and 0.95, the strike price, because it's a call option strategy. The balance had to be bought used at the spot rate, which is the forward rate. Now this is given in the question, exactly the wordings were in the question. So that's the forward rate this is being used for the balance. So you had the US equivalent dollars for this also. Then option cost, this is nothing but the premium. We also calculated this. Okay, so premium of 20 contracts, the contract size is 50,000 into this. We had this, right, 1.02% and 1.64% with this entirely. We had this in dollars. My total outflow again in dollars for 31st of July and 30th of September, right? Total cost in dollars of using the option contract strategy by the finance manager. Now when you compare this, see for July that is 10,000 10,10,000 Canadian dollar outflow. My cost is coming, if I do the option strategy, 9,59,500, and here in case of forward strategy the cost is coming at 9,39,400. Clearly the forward is favorable because the outflow is lesser when compared to the option strategy, right? Call option. Similarly, when I compare to for the September as well, when I compare the both, 6,81,000 and here it is 6,59,000. Again this is favorable, so I'll use the forward in both the cases. So let's see the final decision. As the firm is risk averse and the money is due to be paid is certain, the fixed forward contract being the cheapest alternative in both the cases would be recommended. End of the solution. Simple. Great. Bye bye.